Now that we've developed your revenue projections through market sizing and pricing, we'll continue with financials by factoring in costs. This will get us to the profit projection, which is a key driver in your valuation, plus can help us understand your investment need. It's still too early to be taking an investment since you want to prove the demand on your own first. But knowing this calculation can help prepare you for the road ahead. Let's dig into costs. Revenue won't happen without activity that costs you money and time, effort, sweat, tears. First, consider all of the costs to running your startup. There are two main types of costs. Variable costs change incrementally with how much you produce of your offering. Fixed costs stay the same regardless of how much you produce. Which of the costs you listed are fixed versus variable? In the long run, though, remember that even the costs that seem like they're fixed will need to scale as you grow. This is a mistake of many first-time entrepreneurs, underestimating the cost to grow and not considering the full cost of an item. The other main mistake of estimating costs is chasing after sunk costs. This is when you've already paid some for an item that isn't working and are reluctant to let it go and even pay more money because you have a financial attachment. Watch out for these. One way to better anticipate the costs in later years of your projections is to look at how much money is being spent by similar companies in the industry. A rough estimate can be done by looking at their costs in each bucket of marketing, sales, office space, and more as a percentage of their sales. See what these percentages would yield for the costs of your company and what those costs would go towards. Bringing together costs with your revenues then allows you to determine your profit and to know when you'll be able to recover your initial development costs. Finally, though it's too early to be pitching to investors, we'll cover how to determine your investment need so you'll be ready when the time comes. The investment amount reflects the initial cost to get the business up and running before customer revenue can cover costs. This investment may include your product development, manufacturing, marketing, or more. All of the costs that allow you to be ready to get paying customers. Develop your financial projections by charting your revenue and costs over time. The cumulative amount of negative profit before the curve trends upward reflects the total investment amount. Remember these key lessons. Income is your revenue minus costs. Estimating costs is hard, and you'll likely underestimate. Not all costs behave the same way. Learning how costs behave can help you make financial decisions, such as through your break-even and investment calculations. Know your numbers.